Hello and welcome to the week ahead video with me, David Madden. Before we discuss the major events of next week, let's just take a quick recap of the major events of the week just gone. On Wednesday, we heard from the Federal Reserve, who gave a reasonably upbeat outlook for the US economy. They stated that although there are improvements in the US economy, there is yet to be substantial progress made in relation to the tapering targets. Yesterday on Thursday, we saw the disappointing GDP numbers and jobless claims numbers. This really adds weight to the argument that there is a slowdown or a cooling of the US recovery. And next week, the big event that traders are going to be fixated on will be the non-farm payrolls report. Keep in mind, the last couple of US jobless claims numbers have been disappointing. That's kind of set the tone for the labour market. And if you cast your mind back to the previous US non-farm payrolls report, it was actually quite positive. The headline figure came in well above expectations. There was a positive revision to the previous number, and then on top, but it wasn't a perfect report because the unemployment rate did manage to tick up. So, given that we've seen some signs of weakness in the US economy recently, especially in light of what the Federal Reserve said, that there isn't substantial progress being made in relation to economic targets, the US non-farm payrolls number is going to be more important than ever. Is it going to be a case of some of the recent economic indicators just have been a one-off, or is this the beginning of a broader trend that the US economy is going down a gear? Now, in light of what the Federal Reserve stated, that there has yet to be substantial progress made in moving towards hitting economic targets, there is a growing belief now that the Federal Reserve are going to maintain their very loose monetary policy for longer than expected. Because let's face it, if certain economic indicators are softening, that makes it less likely that the Federal Reserve will move to tighten its monetary policy. Taking a look here at the US30, we can see it's been trading in a reasonably small range for the past 2 days. In the past 24 hours, we've seen yet another new all-time high, which really underlines how strong the market is. While it holds above these two simple moving averages, it's likely the broader upward trend will continue. If we retest and clear the recent all-time high, we could then potentially look to target 35,335. Any moves to the downside could find support from these simple moving averages, both of which have recently acted as support. This moving average, the 50-period moving average here on the 4-hour chart, comes into play at 34,913, and the 100-period moving average comes into play at 34,800. What we have seen is, as a result of the disappointing GDP numbers and disappointing jobless claims numbers, we have seen a decline in the US dollar, and with that we have seen a push to the upside in the British pound versus the dollar. So you can see here that the pound was already rebounding, that the soft US dollar, as a reaction to the disappointing GDP and jobless claims numbers, pushed the currency pair even higher. It's now hit a 1 month high. It's a level last seen in mid to late June. If we continue to press on higher from here, we could be looking at targeting the 1.40 area, and a move beyond that could see a target 1.4131, which is essentially the peak prior to the Fed meeting in June. Moves to the downside could potentially find support from this simple moving average here, which comes into play just north of 1.39. Now, not only do we have the US non-farm payrolls report this week, we also have an update from the Reserve Bank of Australia. Now, the Aussie dollar has seen a lot of volatility in the last couple of weeks. Earlier this month, the currency pair fell to its lowest level in 7 months, so the kind of broader picture is still very much negative. But since then, we have seen a rebound. Now, if traders are wondering, is this rebound just going to be a reasonably large pullback, and that the broader negative trend is in place, or is this rebound the beginning of an overall correction? It is worth noting that some of the upward move we've seen in the Aussie dollar in the past couple of sessions has been more to do with US dollar weakness rather than Australian dollar strength. We can see here that the Aussie dollar has moved lower in the past few hours. While it maintains below this simple moving average here, it's likely the broader negative trend will remain in place. If we do lose further ground from here, we can look to retest 0.7317, and a break below that could see a target 0.7288. If you do manage to kind of break above this area here in at 0.7412, we could look to target 0.7502. Now, the Reserve Bank of Australia are unlikely to be issuing an overly hawkish update, seeing as in the past few days, due to rising COVID-19 cases, cities such as Sydney and Adelaide have actually gone back into lockdown. So given that they're actually reimposing tighter restrictions in some of Australia's largest cities, it's unlikely that the Australian Central Bank will be overly hawkish. That's all from this video. Thank you very much.